Well, welcome to this episode of Capital Decanted. I am delighted to be here in studio with David Haber, who is a general partner at A16Z. David, welcome to the show.
Thank you so much for having me. It's great to be here.
Well, I'm really excited about this conversation with you. I thought maybe we would start out before we kind of dive into investability and segmenting the stack and kind of your outlook for AI and its implications for investing. Let's just back up a little bit to the practice that you have been a part of building at A16Z. And I actually was looking at a little bit of your blogging and your writing, and you had this really fascinating piece, at least I found it fascinating, on
Mm.
distinguishing this difference between a firm and a platform, which I think probably is a pretty enduring view of A16Z from the beginning. But tell us how you manifested that ethos within this AI practice.
Sure. Um, yeah, I first started saying that it was sort of distinguishing this notion of firm over fund. That was sort of like my core thesis, largely to describe where I feel best, which is somewhere between being an investor and an entrepreneur. I've kind of spent my career going back and forth, doing both. Um, I think a firm sort of describes a particular sort of aesthetic of an organization, right? One often run by entrepreneurs. In contrast, a fund, the objective function of most funds is how do I generate the most carry with the fewest people in the shortest amount of time possible? And a firm is how do I just, deliver exceptional returns, which is a prerequisite, obviously, if we're doing either successfully. But the second question I think is also really interesting, kind of intellectual one, which is what are our sources of compounding competitive advantage, right? If I think of Andreessen Horowitz as a company, not just a fund, like what are our moats, right? And every entrepreneur, wakes up thinking about their moats and their sources of competitive advantage. Like, why shouldn't we? And again, there are a lot of ways to be successful. This is not a knock on funds. It's just again a particular sort of type of aesthetic, that I was drawn to. And I think, look, I think there are a number of them that exist in our business. Historically, I think venture capital has always largely relied on brand and reputation, as a source of compounding competitive advantage, and that is still paramount. And venture as an asset class is unique in that respect, in that success begets success, right? Some of the best brands in venture capital have had persistent track record or track records that have persisted far more consistently, than many other asset classes in other markets. And I think that is largely driven by sort of this human network effect that exists, kind of in and around these firms. There's sort of a half joke that Andreessen is a bit of a media company that monetizes through investing, and so we produce a lot of content, like this, to sort of act as the bat signal to attract prospective founders and others, kind of into our ecosystem. And then the last one, and I'm sure there are others, but the last one is really kind of the operating platform. The shape of the firm here at Andreessen is quite different than a lot of other venture capital firms. Today, we have about 600 full-time employees. About 75 of those folks are investors, maybe 30 general partners across our different fund vehicles. But the vast majority sit across our operating platform from marketing, go to market, HR, capital markets, talent. And really, this is this entire kind of war machine in some ways that we make available to our entrepreneurs to really tilt the board in their favor. And that was true from the very beginning of the firm. Mark and Ben were customers of the best venture capital firms in the world, and had been very successful, and sort of had this notion that instead of paying them more with management fees, they were going to reinvest that back into the platform. And that certainly has continued to scale and has benefited from, economies of scale, as the firm has grown over time.
David, I'm curious because that kind of founder first mentality that, as you said, Mark and Ben brought to the firm on day one, also that idea of the full spectrum of a tool belt that you offer to entrepreneurs. Why hasn't that been? Why hasn't there been more facsimiles of that are as successful? It seems like the model is, first of all, it's very attractive to founders to walk to your door, but
Sure.
maybe more importantly, over kind of time and building durable businesses, it's a huge value add for them.
It's a great question. I mean, I think it really requires a very long-term orientation, right? And kind of incentives aligned in that respect as well. I think we benefited in large part from the fact that, I think Mark and Ben were just so successful before they started. Andreessen Horowitz. And so they didn't need, to take money out of the business and pay themselves. They could afford to reinvest all of that capital back into the organization with an eye towards the future. And I think that is, I don't know, incentive drives outcomes. And so I think for most people scale their organizations and that just becomes an amazing wealth creation tool. But again, if you think about it differently and say, okay, what are our sources of competitive advantage? And you believe deeply, that the operating platform can, change outcomes, it becomes a very obvious decision for our companies, which have changed their trajectories. And so I just think it requires patience and a long-term orientation. And those are more rare than I think we might have expected.
Yeah, well, I think to your point, and we overuse these semantics, admittedly, but it comes back to kind of partnership and aligned long term value creation versus maximizing carry, right? And
Right.
that's what you've brought to life through your model. So let's talk a little bit about AI and specifically the practice that you're responsible for. I had, as I think you know, Chris Dixon, your colleague on the show about a year ago. We are talking about cryptography and blockchain and cryptocurrency,
Yep.
and we were talking about kind of the history of new technology platforms and kind of the lenses by which and the conditions upon which you start to identify what is what. And he interestingly started to differentiate between innovation that was more an extension of existing technology. It made you
Yep.
faster, made you more efficient. He called it skeuomorphic, but kind of Web point 1.0 would be a good example of that.
Yep.
Versus something foundational, a complete shift of parallel rails, a native
Yep.
platform, he called it, which mobile might be a good example of.
Yep.
Where on that spectrum, if you like that binary spectrum, or you can
Sure.
pick a different model or framework there, where would you put AI?
It's a bit of both, oddly. Generative AI in particular is almost like a new type of computer, right? Which can do new types of work, right? It is probabilistic in many ways by definition. And it's both kind of an enabling technology, right? It's a technology that benefits from scale, from data, from existing infrastructure and applications and distribution. And so I think it's why you've seen many kind of incumbents adopt this technology to their benefit, right? Many of the biggest hyperscalers are becoming the largest, compute providers in this ecosystem. Many legacy kind of incumbent software companies, albeit, even amidst this sort of SaaS apocalypse that is happening, will be launching kind of agents into their ecosystem on top of the existing kind of UIs that they have. So I think it is enabling in that respect. It is also disruptive for many parts of the technology industry and for many types of businesses outside of the pure kind of software market, because I think what's most different about prior product cycles is that the software itself can actually do the work, right? If you thought about kind of, on-prem software to, the cloud, to mobile, it was kind of the same people accessing the same information, maybe in a slightly more distributed way, but it was really humans doing the work in that software. Today, and even in the last 3 months, we've just seen like massive acceleration of model capabilities. Increasingly, like AI agents can actually, do end-to-end work, much more autonomously. And so, for many software companies that have historically relied, for example, on a seat-based pricing model, this is incredibly disruptive, right? If you're a Zendesk selling, into customer support, call centers, and all of a sudden you have businesses like Decagon that can resolve, 80% of customer inquiries or phone calls programmatically, you no longer need 80% of those seats, right?
Hmm.
And so it requires kind of a transformation of the business model. And in the classic, sort of Clay Christensen sense, that is often a really challenging, thing to do, for incumbents. So I think it has both qualities, which makes, I think, our day job a lot of fun, just sort of debating, you know, where is this technology going to go? How are the incumbents going to respond? How much white space, exists here? What are the moats? But yeah, and things are changing just so quickly every day.
You bring up Clayton, which I think it's an interesting one to kind of build some opinion and some runway around, because his whole philosophy was this idea that new computing platforms, to use your language, kind of come out of nowhere on the weekends, kind of as toys. These are the folks that are tinkering outside of their day job. And so what happens is you get a lot of these startups ecosystem that people scoff at originally, maybe
Yep.
besides the VCs, but people scoff at, and eventually it becomes normal. And by definition, hence his whole practice on the innovator's dilemma, the incumbents have to miss it. In fact, they almost are incentivized to miss it. And so you've described, maybe for the first time, and I don't want to be overly dramatic here, David, but a computing platform shift that has a bit of schizophrenia, because there is some just extension work that these
Yep.
LLM and hyperscalers are participating in, the incumbents. And yet there is some ecosystem world developing around the edges. So how do you reconcile that?
Yeah, it's a great question. I mean, I think what's most remarkable about this technology, especially with what's happening in kind of code development, is it's just democratizing access to being a developer, right? I mean, now I can vibe code applications, in between meetings on weekends, you know, and that's automating a lot of my day job and my work, but it's also creating kind of a platform and making accessible a platform for, I think, millions of entrepreneurs to be created, right? Like, you used to have to, if you had an idea for an app, let's say, you had to go find, an engineer either in your backyard or on the internet somewhere and pay them minimum, thousands of dollars. Now, all of a sudden, with tens of dollars a month, and access to one of these coding tools, you can literally create basically anything. Um, and I think we're just at the beginning of this kind of Cambrian explosion of entrepreneurship. I think that is going to result, from this technology, and that I think exists at the long tail, right? I think that is going to just create, again, millions of entrepreneurs. Some of those will become much larger companies. I think it's going to be sort of a net positive period for society. Um, Again, it is also, I think, potentially an accelerant for incumbents if they choose to adapt the technology wisely, right? If they kind of rethink workflows or rethink software, you know, um, I think those that don't, that view it sort of purely as an extension, maybe miss the bigger opportunity, right? To kind of reimagine how their organizations are structured, right? Just to use this, kind of narrow point, like, I think we were seeing a collapse in terms of the distinction between an engineer, a product, product manager, and a designer. There's sort of, I think Mark Andreessen called this like Mexican standoff, between those three parties, because again, now everybody can ship code. Um, and again, it's just kind of democratizing access to all these tools. So, again, I think it's the other thing. Sorry, just to kind of add maybe one more point. The other thing that's been kind of surprising but really exciting is that so many markets that were never particularly interesting to sell software into have now become radically interesting applications for AI. Largely because, the point that I made earlier, the software is actually doing the work. The TAM is no longer just IT spend; it's labor. And so we're seeing that show up all over the place. I sit on the board, for example, of a company in the plaintiff law market, and they sell software into employment attorneys and in personal injury. This is not corporate law. This is like, the fragmented kind of long tail of law firms representing the individual who've been, wrongly terminated or injured on the job because of negligence. They did not have IT budgets, right? They used Microsoft Word, maybe Clio or Litify on the back end. Uh, and yet, this business is basically, handling kind of the entire end-to-end workflow from intake all the way to outcomes. And I think importantly in that practice, these are firms that operate on a contingency basis, meaning, they don't get paid unless they win. And so there's no theoretical limit to the amount of AI that they want to adopt if it can help them take on more clients and make more revenue. And so, Eve is basically helping, with voice agents, collecting evidence from prospective clients, drafting medical chronologies, creating a demand letter, stepping through all the different phases of litigation. And then importantly, all of the outcomes data, right? How much an insurance company paid out for a motorcycle accident in the state of Michigan, it's not a public data point that any of the model companies can train on, right? And so it's becoming this sort of data asset that is actually better informing and kind of reinforcing the value of the product, because all of a sudden at intake, again, any case that you take on is basically an investment in your time and your labor. Eve can now say, given everything we know about, all the different cases we've ever helped, facilitate, that case is potentially worth 50K. That case actually might be worth $5 million, and manage your labor and your time, accordingly. In that business, in the last, year or so since we invested, which is, again, I would never have predicted 5 years ago that we'd be investing in a software company selling into that ecosystem.
Yeah, what a powerful filter that could be for efficiency and kind of ROI, cost
Totally.
economics. Um, Before we shift to some of those segments, because I want to get back to a couple points you made a moment ago about the Cambrian explosion and the ultimate
Sure.
beneficiary being the public, as often is in these computing platforms. But I want to just take a quick commercial break on the moral side of this, which I just think is also interesting
Sure.
because previous technology cycles, I think, have been seen as hugely beneficial to the public, I think, generally speaking, and
Yep.
largely neutral, meaning the technology itself, right? I mean, that you can use as an agent technology for evil. We've all seen the new Mission
Sure.
Impossible movie and the old Terminator movies, right? You can use these things for bad or for good, but they're largely seen as innocuous instruments for
Yep.
use. I think this seems to be in the spotlight much more now. And I'm curious whether the kind of the Oppenheimer moment, which has been talked
Mm,
about a lot as a corollary here, where he was just haunted
mm.
by the importance of his work and advancement towards the kind of standoff
Yep.
in World War II. Is there awareness of the tension of these entrepreneurs, these big LLMs, and what could happen? Are they self-aware of that?
Well, I think the entrepreneurs certainly are aware of the impact that their technology, might have on society. I think we are techno optimists. We choose to be optimistic about kind of the impact of this technology on society, on the world kind of writ large, and we bet the firm that way. That's one of our kind of our core, kind of company values. Maybe not surprisingly, given where we sit in the ecosystem, but I think if you just look throughout history, even in just America, we've had massive transitions from a labor, uh, you know, um, kind of mixed perspective. I mean, the country used to be largely an agrarian economy, became an industrial economy, shifted into kind of a service and knowledge work, economy, and technology was really the kind of underlying primitive that really drove a lot of those, transitions. And I think we'd all say that, like, we all live healthier and more comfortable lives, largely because of that technology. I mean, you can go back and live in society absent electricity. Most people choose not to do that because I think they benefit from from electricity and their kind of modern comforts. But if I imagine the future forward and what a lot of AI is going to create, look, certainly it's going to create short term disruption. Some jobs will definitely be changed, right? No doubt. Whether the actual tasks change or the entirety of that job goes away. Um, I think in part, like, it's gonna remove a lot of the rote kind of manual work that is being done, in a lot of these jobs. It's actually gonna free up people up to be more human and actually be able to have time to orient around the things, that matter most, which is like building relationships and trust, with your customer, with your partner, with your colleagues. I also think about a future where, every child can have, an infinitely patient teacher, right? Teaching a new language or an instrument or math, right? I mean, democratizing access to that type of engagement is just, I think, I don't think we've yet sort of comprehended kind of the impact that that could have on society either, let alone advances in scientific breakthroughs that I think could come, from, kind of even smarter model capabilities over time. And so, again, like, I think AI is becoming an incredible primitive, across kind of every industry. And I think we're just at the beginning of the, again, positive impact that it could have on society.
Yeah, yeah, fair enough. All right, well, let's shift into kind of what I think is a slightly different topic, ironically, which is okay,
Mm,
we think this is a new computing platform. We think it could change the world. We think it could be a massive positive for both companies, users, as well as the larger public society and allowing them to become more human, to your point just now. But let's talk about the investment thesis itself,
sure.
which, as we know from history, sometimes differs from the actual pace of change that is occurring. And I'm curious, before we kind of segment all the downstream stack, I'd like to start it obviously where everybody's eyes are focused, the Mag 7 and the LLMs and the incumbents, as we called them a few moments ago.
Sure.
As you think about previous network builds, whether it's analog like railroad or digital like fiber optic cables, which I lived through and suffered as
Yep.
an early investor, either very few or nobody made money on that. It was this critical and important and necessary overbuild for future benefit. But as far as those
Yep.
first movers, this arms race didn't yield much of an investment return.
Yep.
Is that something we should be looking towards, or do you think this time is different with these LLMs?
It feels pretty different to me for a number of reasons. If you just think about kind of the .com cycle, I mean, we laid massive amounts of fiber, kind of again in anticipation of this larger kind of network of internet users that would come. But a lot of that fiber, sat dormant, right? It just wasn't being used. I think today, in contrast, most of the people funding the build out of this data center infrastructure and just fueling a lot of the capex are some of the most cash generative businesses the world has ever seen. I mean, it's Google, it's Microsoft, it's Nvidia, it's Meta, and others. And so you have kind of AAA rated credit, basically, funding a lot of this capex build out. And immediately, almost instantly, when these GPUs come online, I mean, they're being used at full capacity. The team, we were at an offsite in Vegas just a couple of weeks ago, and we visited one of the largest data center providers in the country. They're I think the second largest employer in Nevada. They were saying they've completely sold out of compute through, I think, the second half of 2029. And the only way to become a customer of theirs is to be one of those hyperscalers that I just mentioned. Like you cannot be a customer of their data center if you're even OpenAI, right? Or one of our smaller portfolio companies. And it's just I mean, so to me that just speaks to kind of like how early this is, and how much appetite there is for this compute. And the people are not doing this, you know, uh, you know, uh, as a nonprofit, right? They're doing this because they deeply believe that there's going to be huge economic value on the other side of having kind of, harnessed a lot of this intelligence into their products and into their distribution.
Yeah, I mean the WorldComs and the corollaries back then were manufacturing demand by overlaying supply. And so what you're saying is that the supply demand dynamics are actually reversed still. They're still in their favor. They can't keep up. There's a queue at the door waiting to get access.
100%. I actually think the rate limiter is probably energy, more than it is anything else.
Yeah. Yeah. Interesting. Okay. So LLMs there, we talked a moment about them. You've named a couple examples, maybe on the law side with domain specific.
Sure.
You made reference to a couple other software applications. I'd like maybe for the audience's sake, David, if you, because a lot of folks segment the world differently in the stack. How
Sure.
do you at A16Z in your practice think about the different categories of investment opportunity?
Sure. So maybe I'll describe maybe like different layers of the stack, and then also how Andreessen is organized, because I think those are slightly different things. I mean, you obviously have like physical infrastructure, down to kind of energy. You have data center providers. You have the chip makers. You have LLMs. You have kind of applications that live on top of that. And again, I help co-lead our AI apps fund, and just give you a sense for kind of how Andreessen is organized. About I think 18 months ago, we split our early stage venture fund into three. So we have an AI infrastructure fund that invests in data infrastructure, cybersecurity, foundation models, basically anything sold to the developer ecosystem, sort of technical buyers. We have a new business that we built called American Dynamism, which is defense, supply chain, energy, manufacturing, public safety, basically anything with atoms and bits. And then all things kind of AI applications, which you can think of as basically anything, consumer and anything B2B. Um, and so that's kind of broadly how we segment kind of the apps universe. Separately, we have a bio and healthcare business, everything, from, therapeutics, care delivery, and health technology. We have a big crypto business, as given your interview with Chris Dixon, and then a large growth fund that kind of sits across everything, and it'll double down on businesses that are working kind of across the early stage platform. Yeah, so that's sort of the shape of the firm and in a kind of like the layers of the stack. But I'm happy to jump, more deeply into the kind of AI apps ecosystem if that's useful.
Well, maybe I could connect your answer to the LLM question I had a moment ago, because
Sure.
the actual benefit, ironically, the lack of cash flow and the fragility of what eventually became the blow up of those early fiber optic cable layers was actually a moat and a benefit to the ecosystem that kind of developed around it, because those big infrastructure layers were not a participant. They couldn't afford to be a participant. In fact, they ceased to exist in many ways. The big cash generative Mag 7 arguably could vertically integrate down every hint and spark of success, whether it's domain specific, whether it's consumer apps. And I'm wondering whether these segments actually kind of have a chance to develop by themselves. Again, this gets back to this cycle just feels a little bit different than
Mm.
previous models we've looked at.
And sorry, what's sort of the question specifically? Meaning, will
So
the
when
Mag
you,
7 kind of own the model layer entirely, or yeah?
yeah, so the investment thesis for things like consumer application
Yep.
and domain specific. So you mentioned the legal example, and I know you've looked at others. I'm curious what you think of the potential outcomes and success and durability there, given you've got these lurking huge war chests that could
Uh,
diversify at any moment.
yeah. Look, I think the benefit of being kind of at the application layer is that you can really orchestrate work across models, right? And kind of pick and choose, different model capabilities for different, different types of applications. And as more kind of investment in technology and capabilities are built kind of at the model layer, you want to be in an application that benefits from that kind of advancement, not, it isn't sort of competing, there by and large. Um, and I've written about, previously that, context is king, right? One thing is sort of have this technology. Another thing is sort of applying it in the context of a given persona and a given customer. And there's a lot of kind of space in between kind of a model and the application, the technology kind of in the enterprise, in particular. Um, and so we've made, a number of, kind of vertical application investments, again, kind of cross industry. As I said previously, it's been kind of surprising. You've had to be a bit more open minded and maybe sort of less top down, kind of thesis driven in terms of where these applications would show up. But we've made investments in in the home services space, selling kind of voice agent capabilities and dispatching tools into HVAC and electrical and plumbing. Again, not a market I would have ever kind of previously thought we'd be investing in. We have companies, like Salient selling voice agents, doing loan servicing. So, doing welcome calls and payment reminders and actual collections, now working with some of the largest banks in the country and non-bank lenders. And again, I think even in that example, what they're finding is there's obviously a cost reduction story, to some degree, because they're doing a lot of the work that a large kind of call center, workforce might. But they're also finding that the voice agents can speak in 50 languages, fully compliantly. They're infinitely patient. And so it's not just a cost reduction. They're actually finding they're getting 50% better collection rates. And so it's actually driving, meaningful revenue and ultimately sort of delivering a better product in some cases. Um, we also invest, a lot in kind of horizontal applications. So, these are things selling into kind of different personas within the enterprise, a CFO, a CRO, a CMO, a COO, if you will. That space is definitely noisier because you often have large kind of legacy incumbent, public software companies who, like a Salesforce or, a NetSuite or an SAP, and we have kind of a slightly different thesis in the way we invest in those categories. Largely we're looking for companies that are tackling kind of a greenfield market as opposed to a brownfield one. So an example is, we invested in, a company called Rillet, for example, which is building kind of an AI native ERP. And it's less with the thesis that we're going to go rip out, tons of NetSuite, integrations from kind of middle market companies. It's more that there's, always this sort of growing ecosystem of startups that are graduating from products like QuickBooks and are looking for kind of, the sort of next level of sophistication, and that many of those are going to choose the kind of AI native, product as opposed to kind of the legacy, incumbent. Um, but that debate is definitely, one we have every day. Um,
Yeah, I bet. I bet. Any domain specific? Again, you mentioned Eve. Any other domain specific where the thesis is developed and you're just kind of getting started, but you're excited about the potential future?
Yeah, I mean, I wrote this piece called "The Messy Inbox Problem," and we've made a few investments. Actually, I think Eve is an example of this. Tenor in the healthcare space, which I can describe in a second, is another example. But I think we're going to see lots more, and I'm looking for other companies that sort of fit this kind of framework. And it's simply that there's a real opportunity to kind of embed yourself into and integrate into all the different sources of unstructured data. So whether it's your phone, your email, your fax system, and basically train a model to sort of extract whatever relevant information exists in that unstructured information, and then plug it downstream programmatically into whatever the system of record is. So in a sales context, that might be a CRM. In a finance context, that might be the ERP. In a healthcare context, it might be the EHR. And why that kind of is an interesting wedge strategy is that all that unstructured information and ultimately the kind of judgment intensive work lives up funnel of software, right? That was historically done by, kind of the human, right? And so in Tenor's case, for example, they manage all of the patient referrals. So if you go to your general practitioner and they refer you to a specialist, historically they're faxing or emailing over your medical records, and somebody was literally like taking that document and rekeying it into the EHR. Tenor is now doing that programmatically, and so they've kind of wedged themselves again, kind of top of funnel from a software perspective to kind of handle that intake. And now they're kind of eating away at all the downstream workflows. They're doing, eligibility and benefit screens. They're doing prior auth. They're doing scheduling. They're not yet doing this. I have another company actually called Haber, but all of the post-visit workflows. So after you've already seen the physician, there's a ton of work in the revenue cycle, side of healthcare, of actually submitting an invoice, to an insurance company and dealing with the adjudication of over and underpayments. This company Canberra has built a bunch of technology to basically do that programmatically. And healthcare is this really weird industry where many providers are comfortable getting paid 80% of the revenue for a service they've already delivered. When they should probably get paid 98% of what they're owed. It's just a pain to have to go fight the insurance company to get reimbursed. And so Canberra is now sort of a tool to really empower these providers to get paid what they're owed.
It's funny you say that. About 8 years ago, I served as kind of a fractional volunteer CFO for a hospice that had taken care of my mom. So I was giving back, and I
Interesting.
have to tell you what you've just described. I mean, it was overwhelmingly complex and maddening. So
Yep.
any type of
Totally.
automated help would have been massively celebrated in the short observation experience that I had.
Totally.
So fascinating, fascinating. David, the one area kind of in my probably somewhat simplistic taxonomy that you haven't mentioned is what you might call physical automation or robotics. Is that
Hmm.
not a pool that you guys would play in? And do you think there's opportunity there?
We do. It's less where I, personally spend my time kind of on the application layer side. It's more historically where our team on the American Dynamism, side is spending time. But yeah, I mean, they've been looking at, companies in the mining space and kind of critical minerals, part of the equation. We've been looking, we have an investment. I don't know if we've announced it yet, but in Japan, from a pretty famous entrepreneur who's building humanoid robotics focused on public safety. And I'm sure there'll be other applications, but that's one of the first. Yeah, we've looked at all different sorts of kind of, robotics applications kind of cross industry. Again, it's not sort of where I, tend to focus, but it's definitely a huge
Yeah.
opportunity.
Okay. Okay. I'm curious to maybe to force you to kind of have an out of body experience for a moment for this final question, which is
Sure.
instead of A16Z, instead of VC, even generally, um, pull back from kind of early stage price discovery that you operate in, and pretend you're a big CIO of an asset owner that is simply trying to take best advantage of return opportunities through this new computing platform, Cambrian
Sure.
explosion, to use your words.
Totally.
What would be the two or three areas, knowing you've got public buyout, VC, you've got all of these at your disposal now, David, rather than just
Totally.
early stage. Is
Mm,
there what would be the couple that you would choose to kind of double down on?
that's a great question. Look, and we're an RA, so I have to be sort of somewhat careful on like what I advocate for publicly, probably. But so our compliance team can kind of edit out whatever's appropriate. Um, I would argue, given kind of a lot of the competitive advantages that you described earlier. I mean, companies like Google, have massive distribution. They have compute. They have the TPU. They have, by the way, massive stakes in Waymo and Anthropic and many other kind of amazing technology companies. Venture is a weird asset class, as we sort of talked about earlier, in the sense that a lot of success begets success. And, the majority of returns kind of skew towards some of the top firms. Um, so, selfishly, I'd probably advocate for, for some pool of that capital to come this way. Although, there's a lot of peers and competitors that we admire and have done historically, incredibly well. So I think having some slice in kind of early stage venture makes sense with the top brands. Um, I it's interesting. I mean, there's a whole kind of new, I always say opportunities live between fields of expertise, right? And I love kind of living in the gray. Um, and there's kind of this emergent ecosystem. I don't think it fits within our kind of venture portfolio by and large, but there's this sort of like new version of an AI rollup that exists in the market right now, which again kind of requires both a deep understanding of private equity, and kind of traditional rollup playbooks, but also really an understanding of technology and how that technology can be applied to drive kind of the efficiencies and ultimately kind of EBITDA or margin improvement in these underlying companies. I think that there's a handful of people building really interesting platforms just doing that. You have folks like, Jake Sloan building ZBS, who've incubated, accounting rollups and ITSM businesses and others. You have folks like Josh Kushner, who was a good friend in college, building, Thrive Holdings, which is a permanent capital vehicle, kind of doing this. It ultimately, I think, benefits from the eventual kind of cash flowing nature of these entities. Again, I think you'll have kind of a more bounded return distribution, but I think a really interesting opportunity that kind of lives again between the PE world and the kind of venture and tech ecosystem. Um, and then there's probably opportunities in kind of very uncorrelated asset classes. I think back to my first boss who built, I would argue maybe not the biggest, but one of the best businesses ever. He basically invented the asset class of buying pharmaceutical royalties in the mid 90s. He started this firm called Royalty Pharma. And, he was sort of the first person both to understand the value of intellectual property that was historically sitting on university balance sheets. So a scientist, will have developed a drug, they license it to, large pharma company. That pharma company spends, in some cases, billions of dollars commercializing or taking it through clinical trials and then commercializing that drug. And the university retained, call it a 7 to 10% royalty interest, on revenue, from that drug. I think one of the first drugs that they bought was a drug called Humira that treats, rheumatoid arthritis and psoriasis. They found out it also treats Crohn's disease and a bunch of other autoimmune issues. And then they use that perch to then buy up all of their competitor drugs, Atripla, Remicade, and build this amazing platform, not in a fund, but in a permanent capital vehicle, was an LLC. And so they could pool all these income generating assets, which allowed them to raise larger and lower cost forms of debt. And so they had an economy of scale advantage. They had a cost of capital advantage. They had a really complicated target asset that they were looking to acquire. So none of the other PE firms had the depth of expertise that they did, where you had to really understand the R&D pipelines of every large biotech company, the complicated nature of buying this intellectual property. And that just basically allowed them to compound capital for 25 years. Ultimately took that firm public in COVID. That business is, I think today, like a $25 billion market cap with 50 employees. I don't know any business on
Pretty
the
good
planet that
margins.
has
Yeah.
more market cap per person than Royalty Pharma. Nvidia, I think, is like 200 million. This is like $500 million per person. But again, it's just such an interesting story. And I don't know. I'd love to find other businesses that have a similar shape. Maybe that exists in, I don't know, music royalties or other things. But yeah, probably some segment of your portfolio should go into these like diversifiers, kind of uncorrelated cash flow generating assets as well.
Yeah, it's a nice bookend, David, because it gets back to your platform point you made at the very beginning. That instead of, I don't know what you would call the other side, a royalty company or a drug company, they've built a platform, which is a
Exactly.
very different margin structure and business identity. And by the way, I read your kind of in between the spaces piece too, which I thought was excellent. We've been doing a lot of
Thank
work
you.
on the future investment professional needs to be much better at lateral thinking and connecting dots. It's
Totally.
interesting to see what you have done at A16Z and structuring more of a holistic approach to connecting dots across that fund than maybe most of us had previously. I don't think finance has been historically very good at lateral thinking, the way we train and recruit and develop. And we know alpha exists kind of in between
100%.
and in the dark pockets. So I commend you on that.
No, thank you. And it's been a particularly fun way to invest here at Andreessen because we have such, deep domain experts across, the different verticals that I described. And so a lot of what I've done over the past, call it 5 years, is just kind of run around the firm, and lock arms with other GPs and do deals kind of at the intersections. Not all of
Right.
those, by the way, were like AI native businesses per se, but some of them are amazing, amazing companies. Yeah, I'll give you just one example. There's a business called Crux that lives at kind of the intersection of, I would call like American dynamism and fintech. They're basically a capital markets platform making markets between, energy companies, advanced manufacturing, critical minerals businesses, and then corporates and institutional investors. And they started by basically facilitating trades in transferable tax credits that were earned. It was a big part of the capital structure earned by renewable energy companies, became tradable, as part of the Inflation Reduction Act. Corporates could buy those, tax credits at a discount and basically offset corporate tax liabilities. And they've now expanded to like debt and tax equity and a whole ecosystem of large kind of institutional insurance, and other asset managers, kind of facilitate, participating in this marketplace. I think the business has been profitable basically since inception. They have more cash on the balance sheet than they've ever raised, which is not a normal, stat, typically in my portfolio at least. But again, I think it required kind of multiple perspectives to kind of understand that business. And I didn't, I'm not an energy investor, you know, in any means, but I kind of understood the shape of exchange businesses and being kind of, having a network effect and being early to a new asset class. And so being able to kind of invest at the intersections of our two different disciplines, I think is going to create a really, amazing outcome for, ultimately for our, our LPs.
Well, David and listeners, I think that was just a treasure chest of not just wisdom and guidance on the subject matter, but also a look under the hood, which we thank you for, David, of one of the most prominent, well respected tech VC companies in the world. So, David, thank you so much for your time and for opening up, A16's thesis and view of the future with us.
My pleasure. Thank you so much for having me. Really fun.